Hi, Greg Weldon here with the Global Macro Strategy Report for Friday, August 21st. And we got a lot to talk about today. There's a lot of themes here. I could have gone a lot of ways with today's GMSR. I was not planning on doing this. I had UK inflation uh, lined up. I had yesterday's housing market numbers from the US lined up to maybe be Monday. I was going to do UK today, Monday. But this Bessent story, when I saw the clip of him talking to the media, I had to immediately shift. You can read this kind of stuff kind of on your own here. But I asked, it's basically the question here is, I mean, is Trump putting a lot of pressure on him? He's got to come up with an economic D-Day. I mean, so can you set the bar any higher? That's the highest bar you could set. Again, ego and the need to have a win and the need to pat yourself on the back and this whole thing around, this insatiable ego is really what ruins all of this to whatever degree it's going to be a disappointment based on the expectations that have been set. And then you task the same guy, all right, to figure out how to flatten the yield curve and bring the long bond down so you can maybe bail out the housing market at some point in time. All right. At the same time, when the Fed's talking about raising interest rates at the short end, I mean, holy mackerel, forget it. Who wants this job? All right. But what he said is, in clip on this, I want you to see this. I'm going to go through the rest of these charts real quick. We're going to talk about all of this. These charts is basically the text. That's where we want to read that. Okay. But the bottom line is this clip where he says, and he comes out of the meeting, and I think it was right after the meeting in the White House, and I think Trump was there, and I believe that he walks out, and you can see whoever it was, whether it was Secret Service agent or his press secretary or his executive assistant or whoever that was kind of following him and clearly did not want him to talk to the press. And he came over and he kind of was almost like had to straighten himself up a little bit as he gone 10 rounds with the president over what to do about long-term bond yields, and him being the loyal soldier because he's the Treasury guy, not the Fed guy. He comes up with this bond buyback program, and it's already kind of backfiring. And what he said was, once the market understands we're focused on fiscal consolidation and trying to bring the market back to equilibrium, I think, and he quivers and he's trembling. I mean, and I'm not making fun of the guy. I'm saying he's upset because he's under so much pressure to deliver on two undeliverables. I mean, who would want this job? I mean, I sure wouldn't. You couldn't pay me enough. But to say then that I'm confident bonds will continue declining. Clearly, he meant declining in yield. But you're the Treasury Secretary. This is a tell as to how flustered you are right now after meeting with Trump, getting this mandate, this order from the chief executive, from the commander in chief, whatever way you want to look at it, from the corporate side, the Treasury side, the militaristic side, because all these things are kind of consolidated here, and they want to consolidate fiscally. You don't do that vis-a-vis wiping out fraud and cutting back spending on fraud. That's not going to be enough. I mean, if you could save $1 trillion on fraud, it would pay for like 4 months. That's it. It's not happening with $40 trillion. It's just not. His body language was such that he knows he's in overset. The question becomes, is Warsh working with him? Is this why Warsh came out talking tough and way too tough by invoking Paul Volcker's name, but okay, and now didn't raise rates at the last meeting when he really could have, should have. I'm not saying he should have. He could have. And he could have backed up his comments where he might have given more credibility, where he wouldn't have to raise in the future, where now his credibility is already at risk. And now with this, when you look at some of the charts I'm going to show you with balance sheet, the Fed's balance sheet, relative to the maturities that have been, the maturities to which the debt has been rolled over by Bessent, all at T-bills, the Fed is buying a ton of T-bills, hundreds of billions of T-bills added to the balance sheet this year. You say it's over, you need excess reserves, getting more money in the system and so on. We've heard this before. This is not what's happening. This is incestuous, almost like buying directly from the Fed, but at the same time, July borrowing from the public was the largest ever as a means of financing the debt. And the deficit was because they spent twice as much as they earned. Come on, man. I mean, this is like Trump and Scotty on Star Trek, in the captain's chair saying, come on, get us out of here. Right, trying to escape the debt black hole, but you can't provide enough propulsion, which would be print enough dollars, okay, to provide the fuel, burn those bucks to get out of the debt black hole. Now, you could, in theory, in terms of financial markets, but it doesn't really necessarily come without the destructive force of the black hole, right? Because what happens is, if you printed enough money to buy every debt ever issued by the U.S., every bond ever sold, right? Your pizza would cost $800. Your $20 pizza would roughly cost $800 based on today's mathematics. It's actually a little higher now. Since they did the math, it was around 36.5 trillion was the deficit. It was the debt rather. So it's gone up. So take that factor of almost 10%. So it's another $80. So you're talking about $880 now for a $20 pizza. That if they did that would cost $880. Monetary Armageddon. I wrote about it in my book. Fed and Treasury chief turned the buttons at the same time, printed enough money to buy every bond ever issued. And immediately you have inflation. This is done over the long term. Kick the can down the road. You chose this path. There's no turning back. You're into that black hole. The only way to survive is to continue to kind of just get as much as you can to stay away from the destructive gravitational, deatomizing pressure that would be, closer to the center of the black hole. And that's what they're going to do. All right. So basically, it's kind of funny when you get to the Star Trek thing at the very end in the TV show version from which this is drawn in the movie. Great movies, by the way. Excellent acting in these movies. Basically says, I can't change the laws of physics, Captain. That's the bottom line, Donald. Staff Bessent can't change the laws of physics. Okay? Who's your daddy? I mean, the kids that are spending all this money in Congress have taken over as daddy. We, the people, should be the daddy. Then you had, Doge and Musk wanted to be the stepdaddy, all right, and take care, be the authoritative, police-like, scare them straight type of thing, but that didn't work. All right, who's your daddy? Gold is your daddy. And if gold isn't your daddy, you're already orphaned. I mean, it's just, not to be disrespectful to orphans out there. So you can read all this on your own. We've talked about this before. This is Monday's piece. We're going to go through some of the pieces we just did because the charts are pertinent now more than ever. I mean, this is mind-blowing. We talk about all this, and then days later, you get Bessent doing what he's doing. After 2 weeks ago, he's bailing out the Japanese yen. Why? Because they might sell bonds. What, me worry? Come on, he's worried, and now it's proved, and now this is actually the act itself of QE is inflationary. So I just don't even understand. And this is where a guy who's in over his head, because anyone in this job would be in over their head, because you're asking for double mission impossibles. And it's going to fail. And this is where we have to be really careful, for investors, because first it's the dollar, and the dollar's going. And then it's the bond market, and the bond market is showing signs. Japan just went. And then it's the stock market. Bottom line here is the deficit of $432 billion, okay? All right. The government expanded spending by 21%. 21%! And spent twice as much as they earned. Revenue, was down. Even though income tax was up. Wow, that's number one, because no income tax is going to go down. All right, 2.8 million people have dropped out of the labor force, 2.5 million net out of the 316 that got jobs. But this, this is unacceptable. 21.6. I could make an argument. Let's not say safely say that's not true. I could make an argument if we're in a debate team, okay, that the real rate of inflation is 21.6%, because that's the rate of spending increase by the government when they don't have that 21.6% in money to spend, and they borrow it from the public, sell the debt back to the public, pay the public back with dollars that buy less than when you bought the debt. I mean, come on, what do we call that? Charles would be proud. Outlays, 766, receipts, 336. More than double. Spending was 229%. The deficit was greater than revenue. I mean, that's a 2-to-1. Worse, it's simple math, all right? I mean, how much money will they have to print to prevent a total collapse? That's becoming the real question. The deficit as a percent of revenue, okay, so you're talking about 129%, well, the deficit as a percent of revenue for the year to date, okay, with 2 months to go, 10 months, last year, 33.9, now 40. You're going to get to a point where the deficit is going to be half of revenue. And then the other 15% is going to be interest. It leaves you 35% to spend on the things you need to spend on, let alone the fraud probably accounts for 15%. I mean, the taxpayer's left with virtually nothing. Nothing. In this case, you can see this dynamic here on the math. This is really where I've done this math a few times, and I started doing it one way, then I stopped and started trying to do it another way, where it's okay, how many days in a week, and then it was how many work days in July, and then if I do 8 hours a day, how about if I just do every day 24/7? So there was a confusion on my part. These are the best correct numbers I've come up with to date. Let's put it that way. All right. Basically, off of that debt, and you're talking about $361 billion A means of financing the deficit is borrowing from the public. All right. That is up by $500 billion from a year ago, comparable 10-month year to date. That's outrageous. All right. Outrageous. $500 billion. About 20, well, it looks like about 21.6%. I'd say that's in there somewhere. That's real close to the 21.6% they're expanding on. They're taking it from us, we the people. All right. So when you take this number, it works out to 15.7 billion per workday. Use an 8-hour day, all right, 23 work days during July, all right. This is basically talking about almost 2 billion per hour that we the people are just giving to the government without, it's not taxes. There's no taxes. Taxes on the money we earn, and taxes on the money we spend, and taxes on the money we leave for our kids. How many times that single dollar tax? Tax it when I earn it, tax it when the guy that I spend it at his store, he has to pay a tax on it. You also have to pay a tax from the retail tax. Holy mackerel. I mean, AI, if AI is going to be real AI, and I've said this before, and I don't mean to go off point, but it's really, I'm on a roll. I mean, AI, the first thing it's going to do when it becomes aware, when it actually starts to learn, all right, in terms of finance, is going to say, our credit system is a bubble. It's not the right way to go. It's not sustainable. Let's collapse it and start from scratch, which is Armageddon without the monetary part of it. Bottom line, when you talk about this, take a family of 4, okay, with one working person. If it's 2 working people, it's even more. But take one working person, family of 4. They're behind by $1,100 a month already, without taxes. We're talking about borrowing from the public to finance spending that was twice as much as revenue on God knows what. A lot of it's fraud. Back in the ERM, I've told you about this before, so bear with me. You've seen all these before, but we have some new people in here, so I just want to give a full recap on the full story here as to what this means and what Bessent is saying. We need to have the whole scope of the facts here to understand how wild this is, especially ahead of next week at Jackson Hole and Warsh's first appearance. Remember 2018 when Powell introduced R-Star and 11 white papers, 300 plus pages I read every page. R-Star, the whole 9 yards, the new paradigm for the Fed. No tolerance bands on how high we're going to let inflation go. We'll go wherever it wants to go, and we're going to keep it there, till the 8-year average comes up, up to around 2%. That was a landmark. We might get landmark next week, and it could be a steel cage death match with Warsh and Powell facing off, winner take all. Bottom line is, again, I used to work with people that were involved in the ERM and how they brought the European Union together. Currencies were way out of whack. The D-Mark was the base currency. It was back in 1990. And the deficits and the debt that Italy and Spain and Portugal and other countries had. Belgium was one of the worst relative to GDP. Well, you're talking about 6% of GDP as an annual deficit is beyond the scope of what would be allowed under the ERM rules. It used to be penalized until 2020 when they did away with everything, and 2008 when they stopped enforcing the rules. We've been there 6 years running. 6 years running. I mean, just about the deficit to GDP. It's running at 6%, rather. I mean, it's exceeded the red line figure in 9 of the last 16 months. That's where it is. It's years. 1, 2, 3, 4, 5. 5 out of 6. I was incorrect there. 5 out of 6. It's been 6%. Okay, and when you add these 4, that's 9 out of, where do we get 9 out of 16? 9 out of 16 years, actually. I keep saying months. And it's written as months, too. That's why. These are years. 9 out of the last 16 years, we've run a 6% plus budget deficit, annualized. All right? You're talking about 52 years of deficits in the last 56 years. 4 years of surplus. That's it. 4. That's it. The balance sheet's now rising, all right, up by $225 billion, all right, and I didn't even include, actually, I did Thursday's numbers, yes. No, I didn't do last night's numbers. This is from last Thursday. I started compiling this last week. You can see the whole rise here, all right, where you're talking about a significant turn higher in the Fed's balance sheet, $225 billion, all right, and you can see here that they've been purchasing debt 25 of the last 34 weeks, 75% of the times, over 3 out of 4 weeks in a month, they're buying debt and adding to their balance sheet. And the week before this past week was over 11 billion. And, all right, on a year-over-year basis, now rolling 52-week basis, the expansion has gotten to 116 billion, which is two and a quarter a day. It should be a week, or $500 million a day. This is where I first say, who's your daddy? If it ain't gold, you're already an orphan. Why? Because they're printing $500 million a day and borrowing that from the public, and this is out of control, man. And then we talk about the Fed, 225 billion add since the beginning of the year, and have purchased 335 billion of bills, which meant that it's a net add to the balance sheet off of even the maturing debt, all right, because they're rolling short. So Bessent is putting all of the refunding in T-bills. The Fed has blown out their balance sheet. I won't say blown out. That's too strong a word. The Fed has re-accelerated the expansion of their balance sheet in T-bills more than anything else, because 335 versus 225 means it's 100 billion of something else that was dumped or allowed to mature or rolled off. All right. This is a big deal because it's almost like direct. It's incestuous now. Public, Treasury, Fed. Treasury, Fed. Public. I mean, this is kind of problematic. Then I said, with the whole thing around Japan, you know what it was, all right? 40 trillion in debt, 2-decade high in bond yield. Japan, the largest international holder of U.S. debt and the supermassive debt black hole. Yes, we're worried. And here was the numbers. I mean, here's your 40 trillion. This was actually at 38.6 or 38.9 when I did this piece, and already it's at 40. And this was, 3 weeks ago, maybe? August 3rd? Yeah, not even. 3 weeks ago? Gosh, 17 days. Treasury debt, you can see here, but here is GDP. So where did this change? It changed in 2008, the financial crisis. All of a sudden, you see the debt come up to GDP. So we're skirting with the debt black hole. And then in 2020, we blew into it with 8 trillion in newly printed money. And guess what? We're in the debt black hole, and we have accelerated this. This is now almost as fast a pace as this was in 2020. It's out of control. It really is. It's nuts. You throw in 20 trillion in household debt, you got 60 trillion. All right, the 2020 talk that I gave at the World Outlook Conference in Vancouver, Age of Aquarius, I coined this phrase, debt black hole. And that's what you're in. And the propulsion you need to get out, we don't have it. Not only that, but the public now owns over 30 trillion of debt from public debt. With 20 trillion in household debt, out of 60 trillion, we the people own 50 trillion of the bonds, quote unquote, the bonds. Wow. It's just, at some point, it is, say enough is enough. Bond yield at an 18-year high, 30-year bond. Japan, largest holder now of treasuries, 1.143 trillion. Far past China. China's been dumping. China's dumped well over half now of their then peak holdings of U.S. treasuries. And now they own more gold than treasuries, as do global central banks cumulatively own more gold now than treasuries. It's been a sell-off already. This crisis has been building since 2018. That's why I mentioned the 2020 speech, because we talked about it. Then we're talking about the labor market, because it's important. Why? If you have AI take out a big portion of the labor force, those are people that will not be paying income tax. Income tax is key to this because you don't have enough to cover the spending. You don't have enough to cover the interest. You don't have enough to cover the means of financing borrowing from the public. So the labor market is now going up the down staircase. I've been saying this for months. It's deflating from within. And this is all based on the fact you're not creating new jobs. Total employment, 158.8, okay, has grown very little in the last several months, really over the last 2 years, which is ominous because every time this happens, what happens? It leads to something more sinister, if you will. And we see that here when we look at the rolling 12-month change. Every time it's below 1.5 million, you go into recession. Every single time. This goes back to the 70s. And now, since we're 58 million in payrolls back in the 70s, and now 158 million, 1.5 million should be a lot easier to get, right? It's a much smaller percentage. All right? We are well below this. In fact, we've been below this since August of 24. So in essence, inflation been above Fed target for over 5 years, since 2021. And the growth in private employment has been at pre-recession levels since August of 24, 2 years. That's stagflation. I mean, when are we going to call it stagflation? Stagflation. On a percentage basis, it's even worse. 0.2. Anytime we've been below 1, it's led to a recession every single time. going back to the 1970s every time. Every time. And now it's set to do the same. The low posted in February is 0.17. We're on the low right here. 0.17, 0.2, 0.25 last month. I mean, this is really bad, man. Then the number not in the labor force is skyrocketing. Skyrocketing. The ratio of those not in the labor force is almost one and a half. In other words, for every 3 people in the labor force, there are 2 that aren't. I mean, so that's bottom line. I mean, that's pretty radical, and we're going to show you that in other forms right now. The top 10 ex-pandemic increases on a 12-month basis in number not in the labor force, okay? Right here. I mean, these are all top 10. July is 2.8 million, up from 2.6 in June and 2.08. Let's call it 2.1. 2.1, 2.6, 2.8 million, not in the labor force on a rolling 12-month basis. At the same time that the job creation of 316,000 in blue, all right, on a year-over-year basis, versus 2.8 million, you're talking about 2.81 versus 316. It's almost 9 to 1. 9 to 1. Dropouts to newly employed. Only 2 times in history has this happened. 2008-9 global crisis and the pandemic. That's it. And now, that's ominous, man. I mean, that is ominous. And all those people, 2.5 million people. I mean, it's amazing that income tax actually going up. Maybe it's just that collections going up. Overall, the labor market participation rate. Get all excited here. This is good stuff, man. I love this crap. We've been talking about this for a while, man. This is like in a crash mode almost. It's at the lowest level in 50 years. That wasn't this one-off in the pandemic when the entire country shut down. That's how bad this is. 61.4. Last time was February 76 was 61.3. That's 50-year low in the participation rate. And income, well, those that are lucky to still be working, they ain't earning more. Certainly not more than the rate of inflation. And that's the bottom line. Real income, okay? You just see it deflated to 3.5. There's another deflation with the loss of jobs in the month. All right, so this is basically average weekly pay year over year. Take-home pay, 3.5, which is among the lowest since the post-pandemic rise. 3.5, 3.4, 3.2, 3.4, 3.4, 3.5. You're there. I mean, you're one tick away from the second lowest during this entire time, and the first lowest is January 2024. It keeps coming back, this January 2024 level. You're like breaking the post-pandemic downturn low, and you really haven't had any upside. It's bad. And we talk about income versus inflation. You're below it. I mean, inflation came down, actually, since I did this chart, so it's actually about even. It's 0.1. 0.1% real average weekly earnings growth relative to PCE. Actually, it's relative to CPI. That chart's relative to PCE. It's even worse, PCE. So let's look today at the 5-year. Okay, the 5-year. Now, above 5%, does that sound ridiculous? It kind of does, because you're at 440. So it kind of sounds ridiculous. But let's think of how fast the Japanese government bond yields went up, when they had their little crisis earlier in the year. A crisis that everyone predicted for a long time, and finally, bam, it happened. Right, because they kind of, whole yield curve control thing, and the whole thing just kind of got blown out. So maybe they blow out the U.S. before you even really get to full-blown yield curve control where it works for a while. I mean, that's kind of what seems to be happening here. The bottom line is you get above 4.5, it's psychologically damaging, and that opens the door for thoughts that, hey, maybe it can get to 5. It gets to 5, that's a problem. That's a problem. It's like when you're drinking 5 days a week, it's time you seek help as opposed to, 4.4 days. Well, that's not a very good analogy. 4.4 days, you should seek help too, probably. But at any rate, not a judgmental comment, just an observation. The 5-year Treasury note led the way lower, certainly does. Then kind of came back to the 30-year. At this point, the 30-year is leading the 5-year, and this has been the curve steepening that just recently became a little bit of flattening too. That then became steepening again when Warsh didn't hike rates in July. When he first came out, invoked Paul Volcker, said he was going to get inflation to the left side of the decimal point, meaning 1 point something. The curve started flattening, and that was really interesting. The short end was coming, the long end was coming down because they were like, hey, he's going to raise rates, and it's going to bring inflation down. As higher short-term rates, lower long-term rates because inflation's down. Now it's the opposite because he didn't hike. And now Bessent's going to screw this all up, or they're in cahoots. I'm not sure which. I keep going back and forth. I really do. I have to believe that Bessent knows exactly what all this is all about. And this is all set up. And I can't imagine him thinking this will work without Warsh's support. So I wonder, during the interviews of Warsh, was Bessent there? Did Bessent and Trump pick him together? Because, you could say, well, yeah, it's supposed to be independent, but this is Donald Trump. And so he wants the Donald Trump guy in there. Warsh has done a great job of coming out and looking not like he's Donald Trump guy. All right, he's not a puppet, clearly. But that's all talk right now. And now with the chance to hike rates, last month when he didn't do it, he's lost credibility already. And it could be behind the inflation curve already. Does he care? And that's the big question, because maybe not. As opposed to a debt deflation, you'll take the reflation every single time, and that's why gold's rallying. That's why the dollar's getting whacked. That's why the 30-year is leading the 5-year higher. Now, in that context, the 5-year U.S. against the German bobble is now breaking down, violating a long-term uptrend line with a lower high and now a lower low and now a breakdown. All right. So the yield premium in the U.S. is now shrinking, and you can see that is a dollar negative. It's a gravitational pull. It's like a black hole type of thing. And in that case, the dollar's right there, man. I mean, you have a really well-defined pattern up in here, and now you have the whole trend line goes back to the 2008, 2011 low that comes from the 1985 Plaza Accord high, secular bear market, A, B, C correction, right to the 50% of that 1985 move down. And now you're testing the trend line. Now you have the 52-week and 2-year moving average is already bearish. You have the oscillators already turned over. You didn't even get to the 38% retracement of this move. This has been a lame rally in the dollar off of this war, and now it's getting kind of exposed. It's almost like the emperor with no clothes. Frankly, that could be a piece I could write here. I've written that one before. And when you look at this chart, it's really interesting because, you've been down here before, but look at the reversals. You don't stay down here. It's almost like, is there intervention in the dollar already? Below 98? We're going to find out, because 98 is where the trend line is. 97.62 is this low, and 95.55 is huge. Because you take that level out, it's a long-term breakout. We might get an earlier clue if you get a weekly close below 97.84. But you can see the downturn here. You can see this is 61% retracement of this move. Not really as technically significant as this, which you didn't even get to the 38%. That should be 38 also, by the way. Gold adjusted value of the dollar is already broken down. We've talked about this one before. We looked at the long-term dynamic here before, there, and then on the medium term, this is a clear-cut breakdown. I mean, boom, 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 all over. Head and shoulders top, neckline's gone, didn't even get to the 38 of this shorter move, and already rolling over in the oscillator. That's why gold is back in the saddle. I mean, just that simple. Now, what's interesting here is, you come down A, B, C, perfect to the 38%. Perfect in the zone between the 52 and 2-year moving average. The double kill zone, what I call my little phrase, double kill zone, retracement between two major moving averages and two major Fibonacci, especially on the long term of the 52-week and 2-year moving average, exponential. Now, within the open interest dynamic, this is very interesting because the rise in open interest started here and came in here and here. This was short open interest. People getting short, specs getting short, funds getting short. Only here, when you went back above the 52-week moving average, did you get a dip first and then a rise in open interest, meaning you have fresh longs finally coming into this market. They're doing it because the dollar is breaking down, and that changes everything in terms of the previous move that was central bank related. I can't stress this enough. To me, this is a big deal. And that applies to silver too. This is why silver really didn't participate to the same deal. And people were talking about the gold-silver ratio is way out of whack and all this stuff. It wasn't out of whack based on the demand for gold over the demand for silver. All right, it's that simple. Now that's going to shift because this is now a dollar depreciation move that's going to be U.S. wealth-based dynamic of rotation out of paper into metals, and it's going to include silver. So silver is perch poised in position. You know how many times I said below 61, 60 bucks, below 61 specifically, was a back to truck up moment. It's over. And now you're pushing 70. All right. If you get above 71.65, you're looking 88 to 95 and could be in quick order. As the dollar breaks, it could be nasty because there's real key technical levels. All the fundamentals are there. I mean, the labor market's deflating. Inflation is going to go higher. Food prices, El Nino, we already know that. Energy, there's no end to the war. I mean, and then you're throwing this, what Bessent wants to do? QE on the fly with inflation where it is above target and basically above the Fed funds rate. In some cases, close, a little bit of a positive Fed funds rate, but barely. I mean, policy is at best neutral, at worst still stimulative, and he's going to buy bonds to keep the yield curve under control, to keep the long end down. Certainly, the housing market, housing numbers are bad. I'm going to run with those on Monday. All of this is bullish for commodities. All of what I just said, mega. This is the commodity run that we've been waiting for, expecting. This is why we created the program we started in 2018. It's about to take a Mandelbaum leap to a whole nother level. You can see the breakout, the correction. This is a thing of beauty. You're going to be at an 18-year high. You take out this high, and you're right there on the DBC commodity. Not only that, but the 50% year-over-year level, I mean, what do we have? We got like kind of crisis periods, all right? 2008, 20, 21, 22. I mean, those were not particularly good times for the stock market either. So, kaboom. I got to be wondering whether Warsh is in on this or Warsh is now at war with Bessent, because Bessent just made Warsh's job so much harder. And I have to believe, I don't know. I have a hard time seeing Warsh not being in on this, but he talks like he isn't. And so he's either a really good actor, and I've said that he could be the best central bank ever because he's likable and he's the kind of guy you want to like. I mean, just for all the right and wrong reasons. The right reasons in terms of being a human being, seems like a very nice guy. But in terms of being a central banker, it's wrong because it's perfect, because he doesn't give anything away. And I've been saying that the Fed's been too transparent for a while now. But this could be the steel cage death match next week. Bessent versus Warsh. Unless they're in cahoots, we're going to get so much information from this dynamic. I can't wait. It's going to be really exciting. At the same time, here's the chart, maybe the chart of the day. Back in the saddle again is not only gold, but also the DBC Commodity Research Bureau, not called that anymore, but I still do, index. One of the best commodities out there, the best weightings. It's the DBC. This isn't the CRB. Sorry, DBC. I marked it wrong. This is the DBC. A little bit energy weighted, but also you see the ags coming up. It doesn't matter. Any of them. There's a whole bunch of them. The commodity ETFs. Breaking out against the S&P 500. 2-year moving average has been trending higher most of this year, and you're at a 22% VIG, holding commodities over stocks right now. Think about that in terms of AI. All right. And yes, not to say this, but I'm going to say it anyway because we have a lot of new people out there. We are accepting new money right now. And I just think that this is such fertile ground. And while certainly a lot of this is to, continue to build what I can leave my kids because they're going to need it, it's also to help as many people as I can to protect the value and the purchasing power of your money. I mean, think about silver. I mean, I personally bought it 58 and 40, 58.40, like physical silver in the vault down in Idaho. So in that context, I mean, think about that. I mean, in terms of where it is now, $70. I mean, that's holding the value that you can buy with the dollars you get back when you transfer that silver. It's really that simple. I mean, so either buy gold or silver, or find someone that can do food commodities, could be short bonds, could be all these currencies. Gives me a lot more opportunities to match the rates of inflation, if not exceed them fairly dramatically, and help protect investors, credit investors only, protect the value of their wealth and income. It's really that simple. That's it for today. Keep in mind, the GMSR is the research that pays for itself.